We're living in a post-Brexit age. I always err on the side of freedom, so I have been, I guess, a proponent of the Brexit. It has not jived so well with the global equity markets, at least not now. Oddly, we had been down more than the British were, which didn't seem quite right to me. What is going on with the Brexit? Why are people so worried? So the fear is, and these are all people, I guess, who were pro to stay. They wanted to stay. The fear is, of course, is that the European Union is going to dissolve. It's very possible that eventually happens. I've said that I don't think it's possible to tie countries together by monetary policy without having a unified government, and that I thought the EU was likely destined to fail anyway. That being said, England was a funder of some of these profligate countries. Think about it, if you were an American and you were being asked to use your taxpayer dollars to fund foreign countries where the retirement age had been 55. That's Greece, by the way, for anyone who is curious. So the English never really were fully part of the EU. You know, they've had the European, Britain, as we know it, has been around for over the better part of 400 years, 300 and something. I forget the exact number. They've been in the EU for what, about 23 or so. I think they'll survive without being there. And then before that, God knows how, even much longer. So I think that they were always on the pound. They never really went fully into the euro, and I think that the people just were fed up with it, and they didn't really see the reform. I mean, it's very corrupt in the EU. A lot of the laws are made in Brussels, and I think they didn't like having foreigners dictate their policy. And then, of course, I don't want to get too into this, but the mass immigration problem was draining their economy with all the refugees and so on and so forth. So I think the people there just got sick of it, and they said, we're done, get out of here. You know, the United States, think about it. We had our independence in 1776. We told King George to, stick it where the sun don't shine. They came back. They burnt down the White House and tried to take the country back in 1812. And again, we told them to go stick it. And look how we turned out. So I think that this is a great thing for Britain. I think it's been way overblown in terms of the fears, the fear-mongering that's gone down. We'll see how that plays out. So that's my 2 cents on the Brexit. With regard to the markets, what does that mean for the stock markets? So before the Brexit, I think what had happened here was that people got it wrong. They kind of got on the wrong side of the vote. They ran the market up very strongly into the Brexit vote, assuming that it was going to be okay, and it wound up going the wrong way, and people were just massively offsides. So it ran up too fast, and it overcorrected because of the bad positioning by traders and funds and so on and so forth. A lot of people playing for like the kind of last gasp of a move. So the people who were bearish have been bearish the whole time. They're kind of the same group of people. People who are bullish, I think, are very on edge. I don't necessarily know if they're trading with tons of confidence, but neither really are the bears, if you can see what happened the last couple days. So we had a poor high that had led into into this kind of liquidation break. It became a much bigger liquidation break. The 21252 high was a poor high. We backed off from that, and we basically had held where we needed to hold around that level. The Yellen high, when she flipped and became bullish, was on 412, if I'm correct. Yes. So we pulled back, basically right there, a little bit higher, and reversed, and then came up, and we kind of were chopping. We were in a bit of a choppy range. So it had held where it needed to. That, to me, is still the very important demarcation point for the market to stay bullish or bearish, but a couple of things have developed. With regard to SPY, it is making, if you put in the Brexit move, it is now making lower highs and lower lows. That pattern really needs to flip again to get really super-duper bullish. I had proposed that we had had a failed mini wussy head and shoulders, as I refer to it as. I think that was what the exact terminology I used. And maybe now we're trying to form a bit of a big boy type of head and shoulders pattern. That does not necessarily have to happen, and I don't necessarily prescribe to the fact that that's a done deal and has to occur. It is still very possible that this was a false breakdown and we break out to new highs and finally get the blow off top. I will say this though, if you measured from the 212.52 high to the low, which is 198.65, so we still kind of held the range, the real range that we needed to, being 197.86. You know, I've marked the high end of this range being 208.97 and the low end 197.86. So we traded a little bit on the wrong side of the upside, and now we kind of came down to the downside. We're now up above a couple of key levels, but have a couple of key levels in front of us. So let's talk about it. As long as the bulls, in my view, now can hold the 205 quarter to roughly 205.60-ish, I think that the market can kind of catch itself and consolidate and maybe work higher to fill the Brexit gap. If we were to get back below there, I would start thinking things are a little bit more iffy. I have been using that the Yellen flip day as the key, as really in my mind the key level. We've also talked about the 204.12. Any breaks, particularly on Fridays, have led to follow through. This time did not disappoint. We are now, however, though, back above the 200, back above the 100-day, and we are back above the 10-day, and a 50-day coming up. We did just about get, and it got a little bit above there in after hours, to the 61.8 fib retracement of that range, and also a bit of a key consolidation area. That fib is 207.11, and there's an old reference number that I've been using, 206.76. If we can stay above there, I would say that we can continue. If we get back below, it might be a little bit more iffy. This is a lot fast off the lows, and it's basically into some resistance. We also had a bit of a rich close the last 2 days. Today, they're still gunning the futures now. There's a little bit of a caveat here, and I had mentioned this in the weekend review video, that this week was the end of the second quarter, and I had talked about a turnaround Tuesday. We got that. They could run it into the end of the quarter to kind of make up for performance loss. Keep that in mind. We have 2 expirations this week, which is a little bit different than normal, and that's typical of the quarterly expiration. We have one that expires tomorrow. The expected move for that is $1.77 so basically $1.78. And the move into Friday's expiration is $2.37. So we're likely going to see some pinning action tomorrow, and then some more pinning action on Friday. The big put OI is around 205, so I think that will likely be a put floor, at least for tomorrow, to trade against if there was like a gap down or a move down, to play right or right out long against the 205 level, just because we know there's a lot of puts there. By far a lot. It's like in the hundreds of thousands, and then after that it's like, you know, in the 30s and 40s. Conversely, on the upside there, the puts sort of peter out around 67. That's around 209. So roughly around there. I think that's kind of what would be the range tomorrow. What else? I wanted to. There was something nuanced I'd want to say here. So we finished. We had 2 back-to-back now rich closes. The oddly, today's point of control is roughly would repair the poor close from Monday. That's around the 213.75 area, and then today's VWAP was around 220.52. So we had a 22-point rich close. Would not surprise me to see some of that corrected at some point. What would be great for the bulls would be to have a bit of a consolidation day and then go. In my experience, when you get up to a gap, which we are now testing to, and I had said I thought we would at the very least test into the gap, which we are, or did, or yeah, we are. Think like a machine. They always like to test into to see where stops are. Usually, there's an initial back off at the very least. If it's shallow and it goes back into the gap again, it tends to extend. This is all talking normal trading circumstances. This could be just gap and go again tomorrow, believe it or not, into options expiration. Why is this taking place? Why are we getting this violent throwback? One, like I said, it's the quarter end. The more important point is that people had bad trade location when they shorted. I think a lot of people's stops got ran, and they scrambled to get short. It's sort of like, this is the big one. It's always the big one, right? So a lot of people were scrambling and shorting futures. I remember on Sunday night, I had been looking at the futures, and I was planning on actually trading it that night, but I got a little put off by the halt. I don't like being involved when there are halts. Strange things can happen in halts. So that turned out to be the low at the time. We wound up eclipsing a bit below there. But if you were to remove that extra day and the prior day, you are setting up for sort of that perfect move back up, that sort of head and shoulders. I don't know. Like I said, I don't know that that's going to be the case here. It's one possible scenario. I could, like I said, easily see this thing go. Before the Brexit vote, the market was in a bullish pattern. So it may just be it kind of fell out of bed on news and then wants to resolve. This could be a bigger liquidation break. Liquidation breaks tend to, it's hard to say that something this large was just a regular liquidation break. It was obviously extraordinary, but it was fueled on news and it was fueled by people being on the wrong side of the trade. Anyhow, said levels are the ones I'm watching. For the bulls to maintain a healthy tape here, I really do believe they need to be over that 205 quarter. And this area here, they need to get and hold into the gap. If there were to be some little bit of a back off, that would be good. I think, though, we will know what the balance of the summer is going to be next week. I have seen where there are down moves in the market. Expiration week is like up and away every day into the close, and then it falls apart right after there. So I think next week is really going to be the bigger tell on the direction for the balance of the summer. That is my prediction. You may be a little skewed the first day or so because it's the first day of a new quarter and there's some buying, but at some point next week I think we will get our directional answer. Potentially even early in the week. That would be the ideal, but my guess is it'll probably come a little bit more midweek. Anyhow, that's SPY. Let's talk about, there's some confusion about what, first of all, there's a misconception in the news media that I would like to correct at this current time. And that is the relationship between interest rates and stock prices. Stocks are valued if you're interested in this. And I'll tell you, I went to a very fancy business school and I studied to basically become an analyst. I don't really do that. It never really interested me, but I am very well versed in doing DCF analysis. You don't really need to even do it anymore because you could go into a Bloomberg terminal or even go online and figure and it's basically done for you. But when you actually go in and do it, you start to understand the components of valuation. And if you're investing in a project, if you're investing in stocks, if you're doing anything and you want to know what your return is, you have what's known as a hurdle rate. In the stock market, it's what's known as the weighted average cost of capital. And it factors in a stock's percentage of their makeup, which is equity and debt. More and more we know companies are financing with debt. Oracle today came to market with one of the biggest debt offerings, I think, in the history of the world. It was like 10 billion or 14 billion, something nuts. And they're taking advantage of these really super-duper low interest rates. Apple has done the same. This has allowed companies to finance projects that they might not normally be able to make profitable and make them profitable. It has also been a component when you value how much return you want in a stock, has made that multiple that you would pay for those earnings more. It's called the PE multiple premium. If you ever have noticed in the last, I guess, two major market crashes, let's just go back to 2000, 1929 is included in this, by the way, but if you go back to 2000 and 2007, interest rates peaked at 6%. That's when the Fed raises and raises and raises, and finally the market realizes that the risk-free return on bonds is more attractive than dividends. And, if you can get 5 or 6%, very wealthy people pull their money out of stocks and they put them into bonds. Why buy utilities, or why buy Philip Morris's, why buy all these companies and have exposure to potential equity declines when you could just have the dividend and know that the government is going to pay you back your cash, and if you do it correctly, it will be tax-free. Anyhow, that's what happens. We know now from the Fed that they are going to peak interest rates at about 3.5 to 3.25. That will be the normalized rate that they don't even anticipate reaching for 2 to 3 years. We are struggling right now in the 10-year to even get to 2%. It was like 1.46 or something. I think there was a bit of a back off today. TLT actually had a reversal day and it closed a bit lower. I was actually not surprised to see this, particularly on the Oracle news. These big deals have tended to be like short-term tops in the market. The same thing has happened with some of the Apple bond offerings. And traders like to look for they like to try to be smarter than they are, and they say, oh, this has to be the top in the market or whatever. It sounds good, right? Like you're out for drinks. Oh, Oracle came, with $14 billion, and so I shorted bonds. This is how they think, folks. Believe me, I know them. I know them all. Anyway, the reason why, someone asked me today, why are bonds being bid up so much? And the answer, I think, has to do with the hunt for yield. If you had to go in and invest, would you rather buy German bunds with a negative interest rate where you're paying them basically to hold your money or get like 0.5%, or buy into treasuries and get, near 2%? And have the United States government backing your play. So the answer is simple, and that's why we have treasuries bid, because of the spread differential in yields between the U.S. and Europe. Let me just lower this a little. We're getting some sun. This time of day is very tough. I get the sun through my windows, and it ruins these broadcasts. I may have to pick another spot in my apartment to film. But this is where the computer is, so it works out. So that's the story with regard to yield. When people mistake, when they say, oh, bonds are going down, so stocks should go up, it's after you've had these big spikes. And this is no exception. Today was a pretty big outside day. You made a higher high and closed below the 2-day low. So it wouldn't surprise me to see a little bit of a move up in yields. There is still a little bit more room in the channel, so there could be some kind of last gas move, but I'm not expecting, bonds to completely crater. We are close, like I said, close to the channel high. It would not surprise me to see some type of a pullback at this point. But as long as it's not a crazy big pullback, that PE multiple premium is still going to be flowing into stocks. People, like I said, who would normally buy bonds are basically forced into the market. If you go to a bank and you try to take out a CD, for example, you're not going to get enough to really live off of. So people are putting their money into stocks. That's why they're chasing and paying. How much are they paying now? Let's talk about Philip Morris. That's one I used. They're paying for a 3.3% dividend. They're paying almost 25 times earnings. That is quite stunning, folks. If you look at Google, for example, that's only 29 times earnings, and Google is growing a hell of a lot faster than Philip Morris. That is the game that's being played, though. People are chasing yield. Anyhow, that's TLT. So, what else do we want to talk about? I'll just go through the list here. Do they use the first? I'm just reading someone's comment. Friday starts Q3, or do they use the full? Yeah, Friday. You may have some people who wait till the following week. There seems to be like this big fear of holding equities into the weekend. It's the must go home flat kind of crew. By the way, you're in a more of a bear market when the market is down all week and then it rallies on Fridays. That's because traders are taking profits into the weekend. It's sort of, that's like was the scenario in 2011. You'd have all these down days, rally on Friday, and then resume down the next week. It's sort of, that's just, in my experience, in my nearly 20 years of trading, that's sort of how it goes down. All right, so let's talk about some of these momentum stocks here. So you had some very nasty pattern moves in some of these plays. I'll take it from the top. No place better to start than with Apple. So Apple had rallied and got to the 100.72. It actually, what was the high here? I think it was like a smidgen higher. Yeah, it was 100.73. It pulled back past the 61.8, and now I guess we held the 92. You have a bit of a secure low in there with yesterday's bar. So my play yesterday was above the 15-minute high of day. That to me made a lot of sense. Today, Apple had a bit of a continuation. It was a little bit of it felt a little lethargic, but we'll have to see how that plays out. I would say Apple at this point really shouldn't see below, what was this here? I'll discuss this, by the way, more in my weekend review video, but roughly 92, 90, 93, that's sort of the bodies of the bookending candles. If you start getting below there, I think it's going to be a mess. That's just my view on Apple. Facebook, that's really the one I want to talk about, because this was the one I talked about in the weekend review and how to play it. That does also have a bit of a secure low setup in there. I had talked about playing Facebook, that it would get to trend, which it did, and that it would get the gap fill. It didn't quite get the throw past the 200 MA. It stopped on trend to the tick like it did the last time. The fact that it didn't breach the 200 MA to me is a little bit bullish. The key now for me is going to be if it can hold. I have a couple of levels in here that I talk about. I was going to say the key today, the level I was going to use was 110.65, but you're kind of a little bit far away from there. I don't know if you bought it, like, let's say today, if you'd want to wait all that long. I would say if you're late to the party, if you have good entry, the 110.65, you know, if you're thinking a little bit more long term. If you're more short term, you could use the 100 MA here. I like that. That's 112.59. You don't really want to see any closes back below there or the channel. And you might want to look to book some profits up at the 50 MA confluence in the 116s. So if you took that trade, that's where you want to start booking a little bit. In my opinion, that's really what was the old support. It should be a little bit of resistance currently. I got a lot of questions about Netflix. So Netflix had a bit of a look below and fail. Someone was asking me if this was a secure low. The answer is that if you look at it in isolation, it is. But if you look at it in the bigger context, it's really just a double bottom, and to me, more of a look below and fail. You can often have look below and fail set up to be like secure lows. So they're kind of secure low lights. How's that? For me, I like the secure low if you come down and it's the first time down there, like you've been coming down and down and down, and then that's the low and you rally. If you've been down, up, rally, and then come down, I'm gonna coin the new phrase secure low light. So you'll never hear that by anyone else. That is a proprietary term that I just invented right here, and that is what we're gonna call. I think that could be the new nuanced version for this. So yes, you had a bit of a secure low light with / look below and fail. The key level now that I'm seeing is 92.38 to 93.55. Those were the earnings gap down levels from the last couple of times. You also have a lot of hammers around that area. You can see the last few times it's tried to rally is to the 50 MA. So if you're long, I would be looking at books and profits around the 50 MA. That seems to me like it's going to be some resistance up into those 93s, 94s. If it just blows through there, then maybe you see the channel high. I mean, this could go higher. Longer term, I'm bullish on Netflix. Short term, I'm a little cautious. It does have a little bit of a, it's making lower highs and some slightly equal to lower lows. That's not normally what I like to see. In a very broad sense, this could be what's known. This is a harder pattern, by the way, to get the translation into. But to me, it looks like a bit of a lopsided declining head and shoulders. I've said for a while I think this stock is going to see $70 again. It would be amazing if this happened on earnings. It would be a screaming buy somewhere around that area, but that would also be the primary trend and really where the breakout took place. I'm a little cautious. I'm just a little cautious on Netflix. It's also seasonally not that great. I'll tell you, just historically speaking, I've always done well trading Netflix short. For some reason, some of the biggest gains I've ever had in my career have been Netflix shorts. And they usually take place in the summer, so I'm a little superstitious with Netflix in the summer. That said, longer term, I'm bullish on it, but short term, I'm a little cautious. Someone asked about Priceline. So this, to me, is a curious case of a look above and fail. The day at the Brexit thing, it was looking like it was going to break out. I had a lot of people asking me about Priceline. And I said, let's just wait a little bit after Brexit. If you have to do it, do half. I thought the setup looked a little suspicious. Holy moly, this thing was down like almost $158 or something on Brexit. Someone had asked me about around the 200 MA, is this a buy? I said, it's kind of the same answer. If you've got to do it, do half. But to me, it looks like it wants to go. And I'm surprised it actually stopped where it did. I thought that this was going to fully fill the gap to the 11.1068 to 11.2209, which was the 61.8 confluence. I was kind of waiting down there to be a buyer. It never got there and bounced a little bit early. I wouldn't be surprised to see this bounce back up to the 50 MA. It's sort of the backside of the old up channel. But Priceline to me, lower. This to me looks like it was making some higher highs and now making some lower lows. It's just a bit of an ugly pattern, and I would really wait until earnings. If this thing gets really super-duper nailed ahead of earnings, it'll probably set up to be a long. If they rally it hard ahead of earnings, it might be a short again. We'll have to see. Well, talk to me a little bit about it when we get closer. I'll cover Priceline when it gets a little closer to earnings. I used to love this stock, to play this when it was in the 500s. It was actually my pick to be the first of the momentum stocks to get to 1,000, and it wound up being correct. My rationale behind that, by the way, was because it was everyone thought it was going to be Google, and I said it would probably be Priceline. This is ancient history and it really irrelevant at this point, but the reason I thought that was because it's very illiquid and it is prone to very big price dislocations based on earnings and so on and so forth. And I also saw the trend of the movement of a whole industry to online. At this point, I actually think Expedia is better than Priceline. It's sort of, if it gaps, it's not going to gap down 160 points on you and, end your life, end your career, I should say. Expedia, by the way, looking a little bit iffy here. Tesla. All right, so, oh boy, how do we cover Tesla? All right, so it got up to the 265. It actually eclipsed there. It got to 269s, and I had said that was the spot to sell. I really never looked back, and I said that I was looking for it to get down to the 191s, 190, and it had stopped around the 205 and then rallied back up. You're now in a down channel. Watch my video on Sunday. I'll show you what I'm talking about. I do think it's likely to fill the gap here from this Elon Musk buying Solar City. I didn't think it was really as big of a deal. I think it was more that he kind of jumped the shark, meaning that he did something that was a little bit out of the ordinary. Now, a couple of summers ago, when Tesla really had the big move, and that was sort of, I guess, the move that kind of got me famous, right? My call on Tesla, I sort of defied everybody with that and had talked about the big run in Tesla. It's setting up to me to look a lot the same way. You had this down channel, and then the break of the down channel is really what got the move going. So if you missed it, if you got the 61.8, congratulations. You probably want to start looking to book profits now into the 250 MAs. If you're looking for a longer-term trade, like the call spreads, I believe that's how I played it back in the day. I think I sold puts and bought call spreads, if I remember. I mean, it's a couple of years ago, so it's not on my tongue. Although, amazingly, that's probably exactly correct. That was the play. It was in a protracted down channel, and then the break of the down channel got it going. They have earnings coming up. I'm curious to see how that's going to play out. If they rally it hard into earnings, I would suspect that you might want to revisit these lows. If it follows the down channel and we're kind of on the lows, then I might be thinking that this could be a long. The story of Tesla, really, believe it or not, has very little to do with what they actually do. It's a story about the mechanics of the stock market, meaning you have a poorly distributed stock with high consolidated insider ownership. What does a poorly distributed stock mean? A lot of people don't know what that means, I realize. It means that it's not widely owned by institutions. It's not, like, think about institutions. All of them own Microsoft, Apple. Not a lot of them own the Tesla. So it's a poorly distributed stock, high consolidated insider ownership, which is by Elon Musk, and then high short interest. So this thing is like the devil's playground for a guy, like Musk, who can manipulate the stock very easily. I'm sure if it gets down low enough, he'll start tweeting about the stock, and it'll rally. That's just the story of Tesla. I don't really like playing Tesla short. I'm more of a player long, and I kind of pick my spots, if you will. Someone asked about the Yelp. So I've been a bit of a Yelp bull for a while. I don't even know if I still have. I have to look. I have to go through some of my stock inventory. I have some crazy legacy stuff that I sometimes even forget I still have. So the stock looks all right. I mean, I think that this is eventually going to be a buyout candidate. You had a bit of an inverse head and shoulders and a cup and handle that resolved to the upside on the last earnings. It pulled back a bit, but, trading pretty well. There is a primary downtrend line coming up in the 32s, 33s. I would think that it probably gets there. If there's a pullback to trend, like particularly around the 50 MA, that would be a good right or right out area. That's currently around 25.32. I'd be an interested buyer somewhere in that neighborhood for a right or right out play. I do think I think that was also really where it broke down from the last go round. So that area what was resistance, but should become support again. I mean, that's my view. I like Yelp for a long term. If this were to get really super duper crushed on earnings again, I'd probably be back in there looking to buy. The curious case of JetBlue. I had been a little early on this play, but it looks like it's working. I had talked about being a buyer on the downtrend line. It had a bit of a look below range and fail, and then the Brexit nailed it. It broke the range, and then you had a hammer the next day, and now we're back up above those levels. Yeah, so I would say you can go back. This shouldn't break trend again. You broke trend, a little bit of you can call that noise. I've heard it referred to as dangling stuff or whatever. I'll cover this one in the weekend review also. I should just call this video the big tease for the weekend review, right? But as long as you can hold the trend now again and stay above that kind of that range, the first line of support would be 1626. I would say if you can stay above there, it's probably quote unquote okay. Back below there could get a bit iffy. I'm looking for a move up to the 50 MA, roughly around 1820 at the moment. Wouldn't surprise me to see that. I think we covered a lot here. Is there anything else we want to cover? Oh, silver. Let's talk about silver. I've been a big bull on silver for a while, actually. I was a little early. I had to sit on it, but it wound up being right. Yeah, all right. We'll cover Nike actually after that. We'll end on Nike. So silver today had a gap. This to me this could be a bit of an evening star. There is a little bit more range in the channel up to like about 1785. So it wouldn't surprise me to see it get up there. Like if there were a gap tomorrow, I'd be a seller up there for a pullback. but this was a breakout. It wasn't so, it didn't close so well, so I'd be a little bit careful. You could catch probably a quick day trade if you broke the low of day tomorrow. The ideal scenario would be for it to like kind of open flat and then take out the low, but if it were to really do it, it'll probably be a gap, and then that would be, my guess is, a gap and go to probably at the very least try the close to fill the gap or get down to 1709. That's SLV. So longer term, I'm bullish. Short term, this is kind of come up from the top, so to speak. This broke out, retested 15, and now breaking. You know, it just come up a little too far too fast. So I'm looking at books and profits a little bit on the rally. Nike. Let's talk about Nike. This is a really interesting stock at the moment. Yeah, it did. It just kind of cleared it. All right, so Nike was sold off a lot. Often when you get these big splits from these stocks, they get sold off a bit. It came down to an interesting area. It had a gap down. It was sort of a drop and pop, if you will. And it even filled the gap today, so it's not really super duper overbought. Intraday, it closed really basically up at the highs. So you did close above an intermediate downtrend line today, and you closed back above the old uptrend. It had had some time. It was riding it, had the break below, and now back above it. If you can get back up above the reversal bar day of 55.19, I think it will continue to the 50 MA at least, and could potentially go even quite higher, even into the 60s. If this falls apart and like you lost today's low, for example, that to me would be a good write or write out short. If it broke the intermediate swing low, it'll probably retest those after hour lows. Primary trend in this is a real. I was looking at this last night when they reported, is really way down at like 35. I'm not so sure that Nike is going to get a move like that. I think you would need a really big, larger move in the market, but you'd be surprised. Things can get a little bit crazy. So let's use today's range as a key. I actually went out slightly long a little bit of Nike today. I actually bought it pretty well. So I'll probably just use break even on that, or maybe even better than break even. I would use, if you start getting back below today's body, which is, I'm big into using, when you have big range days, particularly with wicks, and you don't have the best trade location, meaning you're not near the top peak or the trough of the wick, I like to use the body. That was about 54.49. So I would say if you're above there, it's probably okay. That was also the body of the last swing lows pullback bar. Like it had the bar and then the next day's body. So I really like that level a lot. 54.49-ish. If you can maintain above there, I'll say that it's probably still a long. If it gets back below there, I'm going to start getting a little cautious and probably pull the plug on the trade. All right, that's my story. I'm sticking to it. If you're not following me on Twitter, my handle is @JustinPulitzer. If you caught this late, if you happen to come into the viewing later on in the broadcast, or you just want to watch again, you can see it on my YouTube channel. I'm going to post it. That's Justin Pulitzer Trades. And I'll tweet out a link to that, the rebroadcast. Anyhow, I hope you all are doing well doing well in the markets. I hope my levels have helped keep you guys either making money or at the very least from losing a lot of it. If you really did follow them, you probably could have saved yourself a lot on the down moves, because any close, like I said, those Friday closes below the 204.12, they don't end well. Anyhow, that's it. See you on Sunday. Cheers.